August ended on a positive note for the US and European equity markets, and September kicks off on mixed feelings. The Federal Reserve and the European Central Bank, they're both expected to cut their interest rates when they meet this month, but the expectations for the rest of this year remain open to bets. Expectation of a jumbo rate cut from the US Federal Reserve has been on the table since last month's US jobs data, remember? So this week's jobs figure from the US will either reinforce that bet or tune it down. So welcome to the new week of trading with Swissquote's daily market talk. So last week and last month ended on a positive note, as Friday's data showed that the US PC and the core PC indices stagnated near the levels printed a month earlier instead of a small uptake. Personal spending in the US rose more than expected and more than income, but the saving rate in the US fell to 2.9% level, the lowest since 2022. And combined with a strong growth number and slowing price pressures printed a day before last week in the US, well, the latest US economic data was good enough to keep the soft landing dream of investors going while reinforcing the Federal Reserve interest rate cut bets for September and at each of the remaining 3 monetary policy meetings in the US for this year. As such, the Dow Jones Industrial Index advanced to a fresh record to close the month of August at an all-time high level. The S&P 500 closed a touch below a record high, while Nasdaq 100 was lower last week than when it started after Nvidia's blowout results failed to surprise investors who became just too used to see fireworks from Nvidia and simply preferred focusing on potential problems instead of the shiny quarterly results and as shiny quarterly forecasts. But besides that, the prospects of looser monetary policy also benefit to cyclical stocks that are sensitive to the economic growth, remember, and that's also causing a rotation from technology to non-technology pockets of the market and leave the technology-heavy Nasdaq 100 index behind its major peers and behind the European stocks as well. Because, well, note that the European Stoxx 600 index also rallied to a fresh all-time high level on Friday last week after the latest inflation update from the Eurozone countries showed further progress toward the European Central Bank's 2% inflation target and also reinforced the market expectation of interest rate cuts in the Eurozone as well. As such, the euro-dollar retreated below the 110.50 level and has room for a further slide below the 110 psychological mark if the Federal Reserve and the European Central Bank expectations continue to adjust in a way to, well, give less weight to the Federal Reserve those who expect the Fed to cut its interest rates at 3 of the remaining monetary policy meetings of the year with a potential 50 basis point rate cut in one of them, and more weight to the European Central Bank those who expect the European Central Bank to cut its own interest rates 2 more times this year by 25 basis points in September and in December. Why not more, right? Because although the inflation figures in the Eurozone point toward the right direction, toward the 2% policy target, the services inflation in the Eurozone still accelerated last month, and some known names at the European Central Bank, as Isabel Schnabel or Joachim Nagel, believe that the interest rate cuts shouldn't happen too quickly to make sure that inflation in the Eurozone returns and stays near the 2% policy target. And besides the services inflation of Europe, the ongoing war in Ukraine and these tense relations between Europe and Russia remain major worries on the old continent, which actually sees its natural gas prices increase into fall. The same worries regarding energy are not true for America, mind you, because natural gas prices there have eased from their summer peak and remain around the $2 mark, while crude oil prices continue to remain under a decent downside pressure of higher supply from the OPEC plus countries starting from October this year, and also the sluggish Chinese growth story. So US crude fell by more than 3% just last Friday, and another 1% this morning in Asia after the official PMI data in China showed a fourth consecutive month of declines in its manufacturing sector, and that despite the Chinese government's efforts to boost activity. So this morning, Caixin data came in better than expected by analysts, but the Chinese CSI 300 index is down by around 1.20% at the time I'm talking here. And almost all gains from Friday, which were basically based on news that the country considers a 5.4 trillion US dollar of mortgages to lower the borrowing cost for millions of Chinese families and boost consumption in China, are gone. Now, coming back to the US. The US markets are closed for Labor Day holiday this Monday, but things will spice up and get the momentum later this week as investors' attention shifts to the all-important US jobs data. The last one before the Federal Reserve is expected to start cutting its interest rates in September. So, the job openings data is due this Wednesday, ADP report on Thursday, and NFP wages and the unemployment rate, these figures are due on Friday. Now again, the Federal Reserve is expected to cut its interest rates 3 times this year, but the pace of these interest rate cuts remain quite uncertain. According to the market's pricing as of today, a total of 100 basis point cut is still on the table, and expectations for the upcoming jobs figures are soft, because analysts expect fewer job openings. Last month, around 136,000 prints from the ADP report and around 164,000 for the NFP number. And the monthly wages growth may have increased a little bit, and the unemployment rate is actually seen a little bit better from 4.3 to 4.2%, but overall, these expectations are pointing at softer jobs market in the US. Now, keep in mind that sufficiently soft data from the US is good for the Fed cut expectations and risk appetite, but a too soft data is good for the dovish Fed expectations, of course, but not necessarily good for risk appetite. Because remember, last month's soft jobs data from the US had boosted the expectation of a jumbo rate cut from the Federal Reserve and derailed the risk markets, and along with the rapid unwinding of the Japanese yen carry positions, had caused a 10% slump in the S&P 500. So, there is a very, very fine line between happiness due to the expectation of interest rate cuts from the Fed and chaos due to the expectation of rapid and jumbo rate cuts from the Fed, on the thinking that the Fed may have missed its call on the end of the tightening cycle, as it had missed the turn at the start of it. Remember, saying that inflation in the US would be temporary, and it has not been. Now, regarding this week's data in the US, the jobs data, the main risk is that we could possibly see stronger than expected figures for the month of August, which could further tame the jumbo rate cut expectations for the Federal Reserve and eventually favor the scenario where the US Federal Reserve would cut its interest rates by 25 basis points for the 3 remaining meetings of this year. And a sufficiently strong economic data, sufficiently strong jobs data, could even boost the expectation that the Fed will cut only 2 times this year by a total of 50 basis points. And I believe that there is actually a greater chance for a hawkish revision in the Fed expectations than a dovish one. So, as such, I expect that the US dollar index, which rebounded during the course of last week, has more room to extend gains this week if of course the jobs data is good enough. So this is all for this Monday. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates, and subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.